Welcome to the June 2026 edition of Let's Talk Markets. As always, our goal is to educate, inform, and empower the families and businesses we serve. So, if you find today's discussion valuable, we encourage you to share it with others who might benefit from staying connected to what's happening in the markets and why it matters. And man, this month, I want to start with one of the biggest market stories of the year, maybe in history, SpaceX and the IPO market. So last Friday, SpaceX went public in what was reported as the largest IPO in market history. The company priced roughly 555.6 million shares at $135 apiece, raising about $75 billion. The stock opened at $150 and closed around $160, up roughly 19% from the offering price on day one. That first day move got the headline, but the reason we are talking about it is not to decide whether SpaceX is a success or a failure after just a few trading days. It is to use that excitement as a way to talk about how investors should think about IPOs in general. So, what's an IPO? An IPO, or initial public offering, is simply the first time a private company sells shares to the public. It creates access. It gives public investors the ability to own a company they could not previously buy. But access and opportunity are not the same thing as guaranteed success. And we've seen this in the past. That distinction matters because with IPOs, the first day, it gets all the headlines. The first year gets the emotion, but the long-term business performance is ultimately what matters most. So let's start with this first chart, just to give ourselves some context around this. This chart compares the average 3-year annualized returns for U.S. IPOs from their first close against the total U.S. stock market. Few takeaways. IPOs have historically had positive returns, but they have actually lagged the broader market. I was kind of surprised by that. From their first close, this chart shows U.S. IPOs returning about 6% annualized over the next 3 years. That's compared to 11.8% for the total U.S. stock market. That's about half. And so that doesn't mean every IPO is bad or that IPOs always underperform, but what it does mean is price, patience, and time horizon. That's what matters. Now, the second chart shows the same idea just another way. This chart compares the NASDAQ 100, the S&P 500, and the Renaissance IPO ETF, which is actually designed to hold large, liquid, newly public U.S. companies with older names eventually cycling out after 3 years. So this gives us a useful rolling look at the IPO market as a category. And the chart really shows the opportunity cost. Since the IPO ETF launched back in October of 2013, that basket of newly public companies has gone up. So again, this is not a nothing work story. But over that same period, the IPO ETF has trailed the S&P 500 by a wide margin and dramatically trailed the NASDAQ 100. So the question is not just, can this go up? The better question is this the best risk-adjusted opportunity compared to what else I could own? And that is the lesson. IPOs are not automatically good investments. Historically, the category has been difficult. Many IPOs struggle. Many never live up to the excitement. But the opposite is also true. A bad first year does not automatically make an IPO a failure. The first day is not the verdict. The first year is not always the verdict either. And what matters over time is whether the company can grow into the expectations investors are paying for. Can the business execute? Can revenue grow? Can margins improve? Can the company turn the story into cash flow, earnings, and durable competitive advantages? That is why time horizon matters so much with IPOs. So if you're trying to trade the excitement, the first few days or the first few months can be extremely volatile. But if you're evaluating a company as a long-term owner, the question becomes very different. You're not just asking, will this stock pop, right? You're asking, do I understand what this company does? How does it make money? What are the risks? And whether the long-term opportunity justifies the price. And so that brings us back to SpaceX. Friday's pop made the headlines, right? We're all talking about it, but it's only the first page of the story. For SpaceX, and really for any IPO, the better question is whether the business can justify the expectations over the next several years. IPOs can offer opportunity, but they require patience and discipline and a clear separation between the excitement of the story and then the evidence of the business. And that distinction, that excitement versus evidence, is a perfect transition into Ryan's market fact, because AI has been one of the most exciting market stories in the world. But this month, the fact worth highlighting is not just stock performances or valuations, it's adoption. And so Ryan called this the race to $1 billion. And when we talk about AI, it is easy to get caught up in the hype, right? It's fun. The stock moves, the headlines, the IPO speculation, the CapEx arms race, the chip demand, and the debate over whether AI is a bubble or a revolution, or maybe some combination of both. But before we even get to valuations, there is one piece of evidence that's just hard to ignore. People are using it, and they're using it a lot. Take a look at this chart. According to Sensor Tower estimates, ChatGPT reached 1 billion monthly active app users in just 36 months. You heard that right, 1 billion monthly active app users. So let's put that into perspective. TikTok took around 68 months to reach the same milestone. YouTube took about 76 months. Instagram, 95 months. WhatsApp, 100 months. Facebook took 101 months. So ChatGPT did not just reach 1 billion users, it got there faster than some of the most important consumer platforms of the last 20 years. And that is the market fact. AI adoption has moved from novelty to mainstream utility at a speed we have rarely seen. And that sets up the big discussion. Well, because as we look at 5 things we are noticing in the markets right now, one of the biggest themes is still the same. Technology and AI leadership remain incredibly powerful, but investors need to keep separating the excitement of the theme from the evidence underneath it. And so here are the 5 things we're noticing in the markets right now. For this big discussion this month, we're going to take a step back, okay? And we are now roughly halfway, which I can't believe, through 2026. And investors have had a lot to digest this year, right? A sharp rally in stocks, strong earnings, continued AI leadership, higher long-term interest rates, and a consumer that feels frustrated, but is still spending. So let's walk through 5 things we are noticing in the markets right now. First of all, the rally has been powerful. After the weakness we saw earlier in the year, the market came roaring back. The S&P 500 gained 17% over an 8-week stretch, which, believe it or not, has ranked as the 20th biggest 8-week gain for the index since 1950. Historically, some of the strongest short-term rallies have been followed by above-average forward returns. But the bigger point is simple. Markets can turn quickly, and we've seen it and we know it. Weakness can feel like it will last forever when you're in it, but markets often recover before the news feels comfortable again. Remember that. The question now is not just whether the market rallied. The better question is, what's really supporting the rally? So this brings me to our second point. Earnings have been a major part of this story. S&P 500 earnings per share far exceeded the expectations in the first quarter, rising 28% year over year. You know what the estimate was? Heading into the quarter, it was 13%. Earnings are now expected to increase by 23% for the year. That matters because last month we talked about one of the oldest truths in the market. Over the long term, earnings and interest rates move the markets. We've said that so many times. Earnings tell us what companies are producing. Interest rates help determine what those earnings are worth today. So when the market rallies, investors should ask a simple question. Are prices rising because investors are just paying more for the same earnings, or are the earnings themselves actually improving? And right now, the answer appears to be both. Valuations are not cheap, but earnings have also been very, very strong. Now, third, technology and AI, they're still leading, right? The market's leadership remains heavily tied to technology, semiconductors, and AI infrastructure. And so technology's relative strength versus the broader market is still sitting at historically high levels. And semiconductor stocks, they've been one of the clearest examples of that leadership. The semiconductor ETF was up 163% over the past year, compared to a 29% gain for the S&P 500 ETF. And that tells us two things at once. Leadership has been powerful, and leadership has also become very concentrated. And that doesn't automatically mean the rally is unhealthy, right? That's not what we're saying. Strong leadership can last longer than people expect, especially when earnings are there to support it. But concentration does create risk. A portfolio can look diversified on the surface and still be heavily exposed to the same theme underneath. So just be careful. All right, fourth, the bond market is still pushing back. Even with stocks rallying, the interest rate story has not gone away. The 30-year U.S. Treasury yield hit 5.18%, its highest close since July of 2007. That's significant. The 30-year has since finally settled back into a range below 5%, but the market also shifted from expecting rate cuts earlier in the year to pricing in the possibility of a Fed rate hike by the end of 2026. And that is important because long-term rates affect almost everything: mortgages, corporate borrowing costs, bond prices, stock valuations, and the discount rate investors use to value future earnings. And this is the tension in today's market. On one side, you have strong earnings and powerful equity momentum, right? That's good. But on the other side, you have higher long-term rates and lingering inflation pressure. A market can rise with higher rates if earnings are strong enough, but higher rates raise the bar. So keep that in mind as we look to see what happens with the Fed and rates moving forward. And lastly, fifth, the consumer is frustrated, right? We're all frustrated at the higher prices, but guess what? We're still spending. And this may be the most relatable chart for everyone watching at home. Look at this. Consumer sentiment is extremely weak. The University of Michigan Consumer Sentiment Index goes back all the way to 1952. And at the time of this chart, it had never been lower. But despite that, retail sales were still up 5.2% over the last year, or 1.4% after adjusting for higher prices. And so that's the strange kind of part of this economy. Consumers feel terrible, but spending has not fully broken. Maybe we just like to complain. I don't know. And honestly, that makes sense. People are frustrated by the prices. We all are. They feel the cumulative effect of the last several years. Even if inflation has slowed from its peak, which it has, the price level is still much higher than it used to be. And the risk is purchasing power. After 35 consecutive months of positive year-over-year real wage growth, right? That's good. That measure's recently turned negative. That's not good. And that's for the first time since April of 2023. So remember, if wages are not keeping up with prices, consumers eventually feel the squeeze. And if that squeeze lasts long enough, it can start showing up in spending, margins, earnings, and the broader economy. So Where does that leave us? As we sit here halfway through 2026, the market is telling us 5 things at once. The rally, it's been real. The earning strength has been real. The concentration risk is real. The rate pressure is real. And the consumer stress is real. The market backdrop is not one-dimensional. Remember, the positives are real too, but the risks are as well. That is why the takeaway is not to be blindly bullish or blindly bearish. The takeaway is to stay disciplined. Discipline means respecting the momentum without ignoring valuation. It means appreciating the earning strength without assuming it lasts forever. It means recognizing technology leadership without letting one thing quietly take over a portfolio. And it means watching the consumer, because in a consumer-driven economy, which we are, spending still matters. Markets like this, they do not reward guessing every twist and turn. They reward process, knowing what you own, knowing why you own it, and making sure the portfolio still fits the plan. And that is exactly the type of environment where a second opinion can be valuable, right? IPOs remind us that the first day headline is not the full investment story. AI reminds us that adoption can be real while valuations still require discipline. And this market overview reminds us that real positives and real risks can exist at the same time. When markets are moving fast and leadership is concentrated, it can be valuable to just take a step back and ask, is risk balanced? Is the portfolio unintentionally over-concentrated? Do bond duration or cash exposure or equity exposure still fit in my plan? And does every position I have a clear purpose? And that's why we offer our second opinion service. We have seen firsthand how helpful this perspective has been for friends, family, and clients. And we would be honored to offer that same second look if it'd be valuable for you. And speaking of finding business lessons in places most people overlook, let's close with something a little more fun. A sports story, a snack story, and a surprisingly good entrepreneurship lesson. So, we're going to talk about the NFL's PB&J economy. Yes, that stands for the peanut butter and jelly economy of the NFL. And so last month we ended with a sports story about the 2-hour marathon, Adidas, and how elite athletes can turn product innovation into consumer excitement. But this month we're going to stay in sports, but we're going from super shoes over to peanut butter and jellies. So take a look at this chart. This is insane. This chart shows how many Uncrustables NFL teams are eating each week. And yes, we are talking about the frozen, crustless peanut butter and jelly sandwiches. According to the reporting behind the chart, NFL teams go through at least, you ready for this? 80,000 Uncrustables per year, with some teams eating hundreds every week. At first, you kind of look at it as just a great fun fact, right? But NFL players are some of the best conditioned athletes in the entire world. Think about it. They've got nutritionists, trainers, chefs, recovery teams, performance staff, and somewhere in the middle of all of that, they are crushing thousands of frozen PB&Js. But this is where the story gets kind of interesting. Underneath the funny headline, there is a real business lesson, because demand can show up in very strange places. Sometimes the opportunity is not obvious because the product feels too simple, right? We're not talking about AI here. We're not talking about space. It's not some complicated new technology. It's a peanut butter and jelly sandwich. But that's exactly the point here. The best consumer businesses, they often start with behavior that already exists. People are already doing something, right? They're already buying something. They are already building a habit around that particular item. And then someone looks at that behavior and they ask a simple question. Well, can this be made better? And if you're a savvy entrepreneur, the bigger uncrustable story makes that questions worth asking, because J.M. Smuckers has grown Uncrustables from a $12 million brand into a $1 billion freezer aisle business with more than $1 billion in sales during fiscal 2026. So the NFL chart, it stops being just funny, right? It becomes a demand signal. Convenience matters. Nostalgia matters. Portability matters. And apparently, even in NFL locker rooms, the PB&J still works. But at the same time, consumer tastes, they're changing. We have seen better for you sodas, protein snacks, hydration drinks, prebiotic drinks, cleaner label products, really better for you versions of almost everything. I saw just the other day, Bluebell is doing a protein ice cream. I got to check that out. Tell me if you have checked it out. And this is not just a small trend. We've seen this globally. McKinsey estimates the global wellness market is now around $2 trillion. And Circana has reported that food and beverage is the largest health and wellness market. Kind of makes sense. So the question becomes here, can the freezer aisle PB&J, can they be made better? And that is where Jams comes in. Jams is a new company trying to modernize the classic PB&J around the things today consumers care about, which is protein, cleaner ingredients, convenience, nostalgia, and athlete credibility. The company markets its sandwiches as having 10 grams of protein, no seed oils, or high fructose corn syrup. And the marketing angle is smart, right? Jams is attaching the product to the exact group that helped make the category famous, NFL players. The company announced a partnership with NFL Players, Inc., the licensing and marketing arm of the NFLPA, to create a PB&J developed with active players. And Sports Illustrated reported that Caleb Williams and J.J. Watt, they joined the brand's ownership group. And that's just smart positioning. A $1 billion incumbent has already proven the demand exists. Consumers are already moving towards higher protein, cleaner label snacks, right? And a challenger brand is trying to connect both trends with the athletes people already associate with the product. Now, that does not mean Jams automatically wins, right? Of course, consumer packaged goods is competitive. Freezer space is valuable. And incumbents like Smuckers, they have major advantages in scale, distribution, manufacturing, and of course, brand awareness. But as a business story, it's fascinating because it captures how entrepreneurship often works in real life. Someone pays attention to a habit everyone else treats like trivia and sees a market hiding underneath it. NFL teams are eating tens of thousands of PB&Js. That's just funny. But a smart entrepreneur might look at the same thing and say, that's not just funny, that it's a product market fit hiding in plain sight. And that's the business lesson. Opportunity does not always announce itself in a boardroom. Sometimes it shows up in a locker room freezer. All right, we are so grateful you joined us today, and we encourage you to share this content with anyone who might benefit from staying connected to what's happening in the markets, because a lot's happening and will continue to happen throughout the course of this year. And that's why it matters, right? We have the replays of all of our Let's Talk Markets posted on our YouTube channel. And if you haven't checked it out yet, you definitely should, because it's home to our Beaver Nuggets and our podcast, Between the Bears and the Bulls. We have an awesome one that we just posted with Sean Aker. I hope everybody had a chance to take a look at that one. We cannot wait to share with you our conversations with some amazing guests coming up as well. And so be on the lookout for those emails announcing the release of our upcoming episodes. There's some awesome ones in store. So as always, if you have any suggestions on what you'd like to see from us, just let us know. We want to make sure that the content we put out is valuable for you. All right, last thing I'll leave you with. Did you hear about the two people who stole a calendar? They each got 6 months. We'll see you in July for the next edition of Let's Talk Markets. And don't forget, Leave it to Beavers.